You've been staring at the screen for hours. Your indicators line up, you find the textbook entry, you click buy, and the market instantly reverses, stopping you out in seconds. Operating on microscopic 5-minute timeframes traps you in chaotic market noise, where logical setups rarely hold. While you're obsessing over a 5-minute scalp, you are unknowingly swimming directly into a massive, invisible wave of institutional selling. Bank desks and hedge fund managers aren't cluttering their screens with erratic short-term indicators. They rely on a single clean benchmark to instantly determine whether global capital is buying or offloading an asset. That benchmark is the 200-period Exponential Moving Average, or EMA. Profitability requires adopting this institutional baseline to filter out the retail static. To a retail trader, 200 might seem like an arbitrary number, but to a bank desk, it represents about 252 days, roughly one complete trading year. The simple moving average lags behind, but the exponential moving average places heavier weight on recent action, sharply tracing new paths. When an asset trades above this line, it's in a bull market. Dropping below means bears are fully in control. This functions as a psychological line in the sand. When price sits well above the average, institutions view the asset as expensive but trending. When it falls below, it's cheap but declining. This single boundary dictates whether the largest players in the financial system are in a state of accumulation or distribution. Firmly apply a strict directional filter to your strategy. Take no long positions below the daily 200 EMA and no shorts above it. Price can only stretch so far from the 200 EMA before mean reversion forces it to snap back. When it moves parabolically away, joining the trend is abysmal. High probability entries occur when price pulls back to touch fair value. To execute this, you start by identifying your primary macro bias exclusively on the daily chart. Once the daily chart provides your directional bias, drop down to the H4 or H1 charts. You wait for price to approach the local 200 EMA, reject it, and trigger your entry. Chaining your entry timeframes to the daily average ensures every trade you take is propelled by the underlying institutional momentum. The market is dynamic, and the 200 EMA acts as a living value zone that breathes with the price action rather than a fixed support line. Placing a stop loss exactly on the line often results in a liquidity trap. Institutions frequently push prices slightly through the 200 EMA to trigger retail stops before the trend resumes. To protect your capital, use the average true range to measure current volatility. Calculate a buffer zone, usually 1.5 times the ATR, and place your stops safely below the EMA. This structural spacing protects your position from predatory liquidity hunts while giving the trade thesis room to play out. Market regime changes from bearish to bullish are slow processes of accumulation, not overnight jumps. The retest rule filters false breakouts when price crosses the 200 EMA threshold and rebounds. Instead of buying the initial break, wait for a 3-step confirmation: the break above the line, the pullback touching the top, and the bounce. This sequence shows institutions stepping in to defend the new, higher price levels, flipping an old resistance ceiling into a new support floor. The 200 EMA reveals the present reality of the big money flow. Audit your current open trades today. Identify how many of them are fighting the primary trend of the 200 EMA. The NX1 account lets you execute these 200 EMA setups with institutional-grade 0.0 pip spreads, utilizing NX AI to identify the structural patterns you might miss. Download the FXNX Institutional Trend Checklist. Stop fighting the noise and trade alongside the global consensus.